Hello! Welcome to section 4 of the webinar. In this section, let's look at how to claim capital allowances, utilization of unabsorbed items, tax exemptions, and CIT rebates. As usual, you can jump to any section that interests you by clicking the timestamps in the description box below. You can also download the presentation slides available in the description box below. These slides include useful links for additional resources and information. First up, capital allowances. Capital allowances are given in place of depreciation and other capital expenditure, which are not tax deductible. Capital allowances are given on qualifying fixed assets, bought and used for trade purposes. You can only claim capital allowances on qualifying fixed assets that you actually use for business purposes. The key exception is S-plated private passenger car. No capital allowances allowed for S-plated cars. Also, you cannot claim capital allowances on items that are considered part of your building structure, for example, windows, floor tiles, gates, or stairs. These are part of your premises, not separate business assets. These are some examples of qualifying fixed assets that the company can claim under capital allowances. So going back to my cookie factory, my cake mixer and my oven will qualify for capital allowances claim since I use them to manufacture my goods, which are the cookies. Let's look at how we can claim capital allowances. First, we have Section 19. To claim under Section 19, you will need to claim initial allowance of 20%. There is also the annual allowance of 80% that is to be spread over the working life of the asset. The working life of the asset is determined by the 6th Schedule of the Income Tax Act. Now, as you can tell, claiming Section 19 is a tedious and long process. As such, Section 19A was subsequently introduced to speed up the capital allowance claim. Section 19A(2), the one-year write-off, is for prescribed automation equipment such as computers. You can find the list of prescribed automation equipment in the Income Tax Act. The 3-year write-off is for qualifying assets such as furniture and fittings, machines as well as vehicles such as trucks, vans and lorries. Lastly, we have the 1-year write-off for low-value assets. These are assets that are originally eligible for a 3-year write-off, but because they are of low value, they qualify for 1-year write-off. Do note that the cost of each asset must not be more than $5,000, and the total claim for 1-year write-off of all such assets is capped at $30,000 per YA. Next, we move on to approved donations and unutilized donation, capital allowances and losses carry forward and carry back. Tax deductions on donations are available to encourage corporate social responsibility and philanthropy. Companies that make donations to approved institutions of a public character or other approved recipients for Singapore charitable purposes can claim tax deductions of 2.5 times. Tax deductions for qualifying donations are automatically pre-filled in the tax returns, based on the information from the approved institution of public character. Companies can check if they have been accorded the tax deductions on My Tax Portal under View Donations. There could be instances where companies may not be earning sufficient income to set off in full the tax deductions, capital allowances claim, or donations. When that happens, there will be an unutilized amount. These unutilized capital allowances and losses can be carried forward indefinitely against future taxable income, subject to certain conditions. I will go through the conditions in the next slide. Unutilized donations, however, can only be carried forward for up to 5 years. Please note that investment holding companies cannot claim current year capital allowances or carry forward any current year unutilized capital allowances or unutilized losses to offset the income of future YAs. This is because investment holding companies are deriving passive incomes and not considered to be carrying on a trade. These are the conditions for claiming unutilized capital allowances, losses and donations carry forward. Firstly, they must satisfy 50% substantial shareholding test. This means that the percentage of shareholding of common shareholders must be at least 50% as at the two relevant dates. Unutilized capital allowances must also satisfy same business test. This means the company must maintain the same business as at the two relevant dates. If the company does not satisfy the tests, the company can write in to apply for a waiver of the shareholding test. The company has to provide valid reasons on the changes in shareholding. Please note that this will be subjected to IRAS's review, and approval is on a case-by-case basis. This slide illustrates how we define the relevant dates for the purpose of the shareholding test. I believe the application here is quite clear, so I won't go through them. I'll pause here to give you some time to run through the example on your own. Now let's take a look at the concept of loss carryback. Under the loss carryback relief, current year unutilized capital allowances and trade losses can be carried back for 1 year immediately preceding that YA. The maximum quantum that can be carried back is $100,000. Also, do note that the carryback relief is not available for donations. Similar to the carry-forward concept, the company must also satisfy these conditions for the carry-back relief. One important thing to highlight is that the company can claim carryback by only using Form C and not Form CS or Form CS Lite. More information can be found on our website, so please take a look if the company wishes to claim carryback relief. This slide illustrates how we define the relevant dates for the purpose of the shareholding test. I believe the application here is quite clear, so I won't go through them. I'll pause here to give you some time to run through the example on your own. Now let's move on to the common tax reliefs to help companies reduce their taxes. Let's start with the tax exemption scheme for new startup companies. If you're a qualifying new company, you can enjoy tax exemption in your first 3 consecutive years of assessment from incorporation. This is a significant benefit to help you with your cash flow during your critical early years. Here is the computation. Here are the conditions you must meet to be eligible for this scheme. Please ensure you meet the requirements before claiming this exemption. Do note that these companies are not eligible for the tax exemption scheme for new startup 1. Property development companies 2. Investment holding companies. For companies that do not qualify for this scheme, you will still be eligible for the partial tax exemption. To claim startup exemption, you will need to input the relevant fields shown here when you file your tax return. Under partial tax exemption, you will get partial exemption on the first $200,000 of your chargeable income. Here's the computation. IRAS will automatically compute the exempt amount in your tax assessment. In YA 2025, companies that are active and employed at least one local employee in 2024 will receive a $2,000 cash payout by third quarter of 2025. The maximum total benefit is $40,000, and it will be computed as per the table shown here. IRAS will compute the CIT rebate automatically in the company's YA 2025 tax returns. Here is the definition of an active company as well as the local employee condition. You will need to satisfy these first to be eligible for cash payout. All right, that is the end of this section. In the next section, you will learn more about filing of your corporate tax returns. See you then.